Good afternoon, and thank you everyone for attending today's webinar, Considering Affiliating with a Hospital, What are the Key Advantages and Disadvantages Physicians Need to Understand, brought to you by Michael Schaff and Peter Greenbaum of Wilentz, Goldman and Spitzer. Please be aware that there will be a question and answer portion today at the end of the webinar. To avoid frequent interruptions during the webinar, please type your questions in the question box located on the right of your screen. They will be answered in the order received during the question and answer portion. Additionally, an electronic version of this presentation will be emailed to all participants following completion of today's webinar. A recorded version will also be available on the website for members only. Again, NJMGMA would like to thank you for attending, and I will now turn things over to Michael and Peter.
Thank you, Dawn. My name is Michael Schaff, and I'm a partner at Wilentz, Goldman and Spitzer in beautiful Woodbridge, New Jersey. I run our corporate and healthcare practices. I'm a fellow of the American Health Lawyers Association, and I do a lot of healthcare matters. And I'll introduce you to my partner, Pete.
And my name is Peter Greenbaum. I also am with the law firm of Wilentz, Goldman and Spitzer, and I too am on the partner on the corporate and healthcare teams, doing a lot of work with hospitals, physician groups, and other healthcare providers.
Right. As Dawn indicated, our topic today is considering affiliation with a hospital. Okay, what are the key advantages and disadvantages, and what physicians really need to know or to understand when they're doing that. This is for the New Jersey Medical Group Management Association, but we do have a few extra guests from both the Maine and the Vermont Medical Group Management Association, and we will welcome them to this. So our presentation today, we're going to talk about some general trends of the continued erosion of the traditional medical staff hospital dynamics, some mega trends associated with that. We're going to talk about some overviews of affiliation models, focusing primarily on direct employment and professional service agreements. Then we're going to go through and we're going to compare a number of the issues and concerns between the two models that we're going to discuss, the professional service and the direct employment models. Those issues that we're going to discuss are going to be group considerations, integration considerations and how you join, sale or lease of assets, compensation and benefits, whether or not there's a budget, and if so, how does that work? We're going to talk about the term of these agreements and how these agreements can be terminated. One of the things we're going to focus on is unwinding. If this does not seem to be working, how do you unwind and go back to your practices? We're going to discuss a restrictive covenant in these situations, some information technology issues, and then some operational considerations from a practical sense. When we're done with that, we'll touch briefly upon, provided we have some time, some other options that practices have in addition to hospital affiliations. So let's go through the mega trends which affect hospital physician arrangements. As you all are aware, the payer mix is eroding, and there's increased economic pressure from these types of things, and it makes it more difficult for a practice to continue on. You know, there's declining income, okay? Although expenses apparently don't seem to want to decline, everyone wants to get a raise. There's accountable care issues that come into play. There's pressure which creates insecurity from the reform driven by CMS to control costs for efficiency and also for quality. There's continuing pressures from payers, like on pay for performance, on full networks, and tiering of providers that many of you may have already experienced in New Jersey, like with Horizon. And there's also issues with respect to clinical efficiencies. There are other eroding payer mix issues, including physician practices' demand for income support from the hospital. You know, for example, if they need to recruit other physicians. There are joint ventures regarding ancillary services between physicians and hospitals. Physicians are requesting and in many cases getting call coverage payments from their hospitals. They're also getting medical director stipends and payments for those types of services provided to the hospital. And then since everyone's trying to create additional revenue, there's issues with respect to ancillary revenue streams and the creation of them, as well as the competition between the hospital and physicians as to what type of ancillary revenue streams each of them have. There is also the misalignment currently of physician and hospital reimbursement methodologies. They're different. Physicians get generally a fee for service at this stage, although there are many different changes going on with respect to that, versus a hospital per case. And depending on your specialty, there are a number of other significant different types of payment methodologies and how they're changing. There's also a further erosion of the referral base as primary care physicians are aligning with other entities. So, for example, in New Jersey, you have someone like a Summit Medical Group or Advocare or a Sovereign who are acquiring primary care practices, and specialists are losing their referral bases. So we assume that the people in Maine and Vermont have similar type of situations going with respect to them. The second item that's happening is there's increasing operational infrastructure expenses. Okay, it costs more to do a practice now. It's now eroding more of the bottom line. So if the revenue stays the same, these added costs are really creating problems for the practice and the physicians involved. There are high capital costs. As you buy more equipment, et cetera, there's shared disappointment regarding the electronic medical records and other types of related IT integration initiatives. There's tremendous increased security costs with respect to electronic data, as you're all aware of. There's also reimbursement reductions if you don't implement electronic health records. So you have to recognize all that. Patients are demanding patient portals, which again, as they increase their costs associated with the internet and use, there's security and other costs that are just rocketing up and being very, very costly. We also have a changing profile of the physicians, what I would call the new physician approach, and allied health providers. Medical staffs are aging, okay? Residents and fellows and new practitioners are really risk adverse. They're not entrepreneurial like the older physicians, and a lot of them just want to come in and just work and go home. There's a different culture associated with that. Their lifestyles are different. They want to be able to plan. Their biggest issue is, do I really need to be on call? I don't want to be interrupted in my life. And there's economics associated with it. There's also the erosion of medical staff alliances, particularly amongst primary care physicians. So now there's a lot of medical staff privileges at many different hospitals and systems as the systems seem to grow and grow and grow, and you kind of have to pick your spot. There's also limitations on compensation plans that are supposed to drive the behavior that the physicians have, so it becomes more and more difficult to make sure that the doctors do the right thing, and the best way to do it is making sure their compensation plans are drafted appropriately. There's a physician generation gap going on in the emergence of it, and there might be some existing and impending physician shortages. So I've talked about some mega trends, and I figured I'd lay out some of the hospital affiliation models. Some of them are highly integrated and complex, while others are very, very simple. And I've put down 9 different types of models here. One is the traditional, which is the traditional medical staff that's kind of going a little bit slower. Then there's physician recruitment, which is another type of affiliation arrangement. There's medical directors and personal service agreements. There's management service organizations being created around. Hospitals are setting up certain types of centers of excellence. There's some joint payer contracting arrangements. There joint ventures going on between hospitals and physicians. There's co-management and clinical co-management and service line management agreements. And we also have a number of other items like clinically integrated networks. and ACOs that are part of this process. And then the last model is physician employment over here. So as we go through this, we're going to talk primarily about two of these types of models. And the direct employment model there's a picture of it on your screen. And even though I have some key provisions on the next couple slides, I think it's best to look at what's going on here. If you see this on the left of the hospital, the system are the payers, and on the right are the independent physician groups and another independent physician groups, and it's through an employment agreement. So what ends up happening is physicians are employed directly through the hospital or one of the hospital subsidiaries via some type of formal written individual employment agreement. It's on a case-by-case basis. So if you're currently in a practice that has 4 physicians, each one of them would enter into their own physician employment agreement where the employer would be either the hospital or a hospital affiliate. And then the hospital, as the employer, is responsible to pay and to supply the office, et cetera, associated with it. And there's standard types of benefits and compensation, and it could be structured in many different ways, and we'll talk about that. And it sets forth what type of services are going to be provided by the physicians. Keeping in mind that the physician's salary in these situations must always be based on a fair market value compensation, and many times it's based on some type of work RVU or some type of percentage of collections or net revenue basis. And in these instances, what happens is the physician assigns his or her professional fees to the hospital. So you understand what that is. It's just like a regular employment model where the employer is the hospital or the hospital affiliate and the doctor is the employee. The next type of model that we're going to discuss and compare is the professional service agreement model. As you can see from this slide, it's the hospital on one side and the physician group on the other. And as part of this, generally, there's 2 agreements that are signed between the parties. Number one is either an asset purchase agreement or a lease agreement or a combination of them both, where the hospital basically either leases or acquires the assets, and if the assets are not acquired, the physician group continues to lease them to the hospital. And then there's an agreement between the hospital and the practice to provide management services and the medical services associated with it. So what ends up happening is physicians retain their group as a professional corporation, and that generally employs and compensates and governs the physicians or the physician extenders. Then the hospital, either directly or through a wholly owned subsidiary, purchases or leases the practice's assets. Again, that has to be a fair market value, and converts it to some type of hospital-based facility. And then the hospital purchases the physician's services from the group pursuant to a professional service agreement, and generally they pay an amount based on work RVUs. And the key provisions here include that the group typically continues to employ and compensate all the non-physician and provider who support the practice, like the support staff, the administrative staff who are leased to the hospital, and they're reimbursed for it. And then the other operating expenses are being reimbursed to the group for those services. So in essence, the practice becomes a subcontractor providing the services to the group on behalf of the hospital. Typically, the hospital negotiates all the payer contracts, and they bill and they collect for all services using their provider ID number. Both parties generally execute a multi-year professional service agreement and a management service agreement, which summarize the key terms associated with that. Keep in mind that when you're doing these professional service agreements, it's really as though the hospital is providing the services where the doctors are being assigned over to them, and even though they get paid, the doctors get paid by the practice, the practice gets its revenue, instead of billing insurance companies, they bill the hospital, who in turn bills the insurance companies associated with that. So let's talk briefly about the professional service arrangements and the direct model arrangements, and what issues are important. You know, there are a multitude of issues. We've decided to pull out 10 which we think are really important, that need to be looked at very carefully if you're deciding to enter into these items, one of these types of arrangements. And we're going to contrast these and compare them. The first is the group considerations. Second are integration considerations. We're going to discuss sale, whether you want to sell or lease these assets. We're going to talk about how you determine compensation and how benefits are dealt with in each situation, whether or not there's a budget and whether or not you have to live by this budget and what this budget means. We're going to discuss the term of the agreements, what's typical, and how it can be terminated. We're going to focus on unwinding these deals because, you know, hopefully these deals go on in perpetuity, but it's important to make sure that if there is going to be an event that triggers an unwinding, that it's doable and that you can go back to practice a lot easier. We're going to talk about on termination, and while you're working there, what are restrictive covenants are applicable and how they're dealt with. We're going to discuss information technology issues, and then we're going to go into some practical operational considerations. And with that, I'm going to turn it over to Pete to talk about the pros and cons.
Thank you, Michael. Michael just went through the 10 items that will go into more detail, the first of which is the group considerations. Why does a group and a group of physicians elect to go into a relationship with a hospital? What do they get out of it, and what do they need to think about from a negative side? So from a positive side, the physicians at least hope to see more consistent cash flow and access to hospital resources. So from the cash flow perspective, there is no longer the concern, generally speaking, of the billing lag and the risk of non-payment. You submit a bill, you get paid 30, 60, 90 days later or longer. You certainly don't get 100% of what you bill. Theoretically, with a hospital relationship, that risk goes away. The hospital is going to do the billing and collecting, and you're going to be paid a flat salary or based upon RVUs. And we'll get more into detail on that in a minute. Separately, what else do they hope to get out of it is more resources. Needless to say, the hospital has more employees, which means more resources, more departments, HR departments. There's the thought of a lot of forms and paperwork that need to be prepared, and hopefully the hospital can alleviate some of that burden. So that's what physicians look at when going into it from a positive perspective. But unfortunately, from the negatives, there are always negatives when entering into any type of relationship with the hospital. First, you lose your degree of freedom, your autonomy, and this is even more so in a direct employment model. So you lose from the financial perspective, the freedom that you previously had. When you were in private practice by yourself, you wanted to buy a piece of equipment, you wanted to hire somebody, you did it on your own. Now when you're aligned with a hospital, whichever model you're in, you need to get hospital approvals for that, whether in advance or as time goes on. And so without that approval, you cannot do what you want to do, or if you do it, it'll be at your own dime. From an operational perspective, similar to what I just talked about, you're used to historically going to buy equipment on your own, supplies on your own. Now you are within the confines of the system itself. If you are a direct employee, all of your expenses have been moved over to the hospital, which means it has to go through the hospital system in terms of buying and procuring. There's a long lead time from the initial discussions to actually going live. If there is a real desire to get something done quickly, you can get it done quickly, but our experience is that you're not looking in terms of a matter of weeks, but rather months between the early discussions and actually going live.
And keep in mind that whatever time the hospital tells you it's going to take, the odds, over at Monmouth Park are very high on that actually happening.
So you'll start with the early elementary discussions between the physicians and administration. Eventually, you get to the level of starting to negotiate a contract. There's many layers in terms of administration that needs to be gone through with all of the changes and all of the discussions. Eventually, you get to contracts that everybody's comfortable with. Once you sign the contracts, typically at that point, the hospitals will then start the integration process, the pre-go live integration process. That's things like credentialing the physicians on the hospital payer agreements, dealing with intellectual IT issues, the EMR systems and the like. And then eventually you get to the go live stage, which again could take a while. So in terms of the timeline, it's not something that you're going to want to say, we're going to start and finish this thing and get it done within a matter of days or weeks. It's a really long process, so you need to be prepared for it. Needless to say, there are costs to the practice up front. You've got your professionals, your accountants, your attorneys, et cetera, that you need to deal with. You have other startup costs. You have the actual production ding that you take because you're going to have one or more physicians that need to roll up their sleeves and deal with this. And so the loss of production on that end, which is the loss of that dollar. And last, it affects your retirement. This is always a good time to take out your organizational documents. Economics change, things change, and so you want to make sure that the internal processes that you've got are in line with expectations.
Keep in mind that if you're part of a group, you have to realize that if you're going from a different billing collecting model, that over the next several months there may be a windfall of dollars because the hospital may be paying you based on the billings and not on collections, and you have a lot of accounts receivable sitting there. So during the first year, there's generally a significant windfall of dollars, and at the same time, you have to consider that if you leave, and Pete may discuss it during the unwind, that you're going to need to make sure that you have money to go back in your old practice because you've already got it.
One thing that is super important to think about is you're going into this obviously with the expectation that either you're going to cut costs or probably more importantly, make more money. And making more money is going to be realized by increased reimbursement through the arrangement. You need to make sure that whatever you have done historically, when you put it into this model, the economic model, that the numbers make sense. We talk in terms of RVUs a lot of times in terms of how practices will get paid on this. Well, go outside of the hospital system when you're on your own, you typically do not talk in terms of RVUs. You talk in terms of CPT codes. You talk in terms of collections. And so you need to translate those phrases into whatever it is, the economic model that's going to happen once you join, and make sure that the numbers at least make sense on paper. So with that being said, what other integration considerations do we have? Again, before you go live, your staff will need to be changed. That's physician and non-physician staff. From a physician perspective, the physicians and clinical workers will need to be trained in terms of how the charts would need to be prepared in the hospital system, how the paperwork needs to be done, and things along that line. The non-clinical staff will have their own set of training guidelines that they need to deal with. From an IT perspective, and this is typically a very critical item in terms of EMR, for those groups that are paperless or somewhere between paperless and electronic, you've got a system that that hopefully you like, that you certainly have been working with. When you join a hospital, they typically have their own system. So the question then becomes, whose system are we going to use once you go live? Is there the ability to stay on your own system and somehow link them up? or are you going to be forced at some point, whether immediately or later on down the line, to go onto the hospital system? And needless to say, when you go on the hospital system, it's a whole different set of rules that you need to understand. The systems, you need to basically relearn the system. When you go live, as Michael just alluded to, you'll have accounts receivable that are still owed to you for dates of service before the go live date. So that's going to be your money to put in your pocket. The question then becomes, how do you collect that money? If you've got your own billing company, great, that's how you do it. If not, you may have now assigned or sold off all of your staff, all of your equipment, which includes your computers, et cetera, to the hospital. So from a logistical standpoint, you just need to think about, how am I going to collect my receivables? You may have many offices with office leases. You may have equipment that you don't necessarily own, that you lease. And so in the whole context of the affiliation, what is going to happen with each of those relationships and agreements? Do the underlying office and equipment leases, are they going to be assigned over and formally taken over by the hospital? Or is there going to be some type of other arrangement to deal with the financial impact of that? At the end of the day, it's the expectation is all those expenses will one way or another be picked up by the hospital. In terms of going or pre-live activity, oftentimes there might be some construction-related activity going on. The hospital may have certain expectations in terms of the layout, the appearance, and just the overall office itself, and any type of construction that may need to be done. You need to factor in, and importantly, how will that impact patient volume and flow?
Keep in mind that if the physicians own or family members own the office, the hospital is going to want to do a fair market value analysis as to the lease and make sure that it's based on fair market value, not just a made-up number between the real estate entity owned or by the doctor or related parties and the entity.
All right, so next topic is, what are you doing with your assets? You've got a practice, you've got equipment, you have charts, you've got tables, you've got chairs, computers, and the like, all the hard assets in the practice. So what is going to actually happen on the affiliation with each of those pieces of equipment and assets? There are two basic principles or avenues that are typically discussed. Either you sell all of those assets to the hospital and you get a payment up front, or you lease those assets as opposed to selling, and you lease those assets to the hospital, and in exchange, instead of an upfront slightly larger payment, you get monthly lease payments from the hospital. So the question is, what are you going to do with your assets? The first concept is that whatever you're doing, the economics need to be at fair market value. And it's at this point that we pause and think that what a physician thinks the practice is worth does not necessarily align with what a hospital is willing to pay. A hospital is typically going to pay based upon a fair market value number, which is a book value or depreciated value of a hard asset, which is not necessarily a large number. So it doesn't necessarily align with the expectation of the physicians that you have a super valuable practice.
Right. They generally don't pay much, if anything, for goodwill. So they have concerns about it being deemed a kickback.
Exactly. So with that in mind, and still, oftentimes a group will sell their assets. They get some type of cash payment up front, and when the relationship eventually ends, then the assets need to be reacquired back by the physicians. Alternatively, as I said, is you could lease the assets to the hospital. So you retain title. You instead of a large upfront cash payment, you get monthly cash payments, which provides an ongoing cash flow to the practice. Again, it may not be what you would expect in terms of the actual dollar figure, but it nonetheless is a monthly payment.
Right. The practice generally don't get rich on selling the assets to the hospital. It's normally a low value. The upside from a physician perspective is more on the compensation and how they structure it.
Exactly. And from an ease on an unwind perspective, this is the easier scenario because you do not need to buy back your assets or get back title to your assets. You already have it. So essentially what you do is rip up the sublease or license that you've got, and you, in essence, have stopped that relationship. So more specifically, if you've got a lease, what do we think about in terms of the lease? What exactly are we leasing? What is the actual lease payment? And then keep in mind that there are ongoing costs in terms of the equipment itself and maintaining the equipment. You actually are going to, again, keep title to the equipment. So there's a responsibility in terms of the upkeep with maintenance contracts, for example, on software and in computer equipments and on the utility systems or building systems that are in the space. There is an ongoing cost. Who's picking up that cost? How is that cost addressed? At the end of the day, one way or another, the expectation is that the hospital is going to pick it up. And so you just need to make sure that one way or another it's factored into the numbers. Alternatively, what's the components of a sale? Same thing, what are you actually selling? Then identifying the price, and then does the bulk sale law apply? I know we've got some out-of-state folks on the phone here. In New Jersey, the bulk sale process is that anytime a seller of a business or anytime a business is selling its business, which includes its assets, that triggers a notification to the state, and that's called the bulk sale process. So we in New Jersey, hospitals would typically insist on that, following that process. So you need to look at your state's bulk sale laws.
Right. In some states, what they do is require you to notify every creditor and give them a certain amount of notice to make some claims. So you really have to look at it from state by state specifics.
And lastly, are any of your assets leased or have some type of lien? For example, on the lien perspective, it is certainly not unusual that the practice has a line of credit with a bank, and in that case, it would be expected that the bank has a lien on all the practice assets. So if you're selling your assets to the hospital, then you need to one way or another deal with that bank and deal with that lien.
And many times we ask our clients, do you lease anything? And they say no. And then we realize we ask other questions as a follow-up. What about, do you have a Pitney Bowes machine for postage? Yes. We pay X dollars a month for it. Well, that's a lease. What about a copy machine? A lot of times those are leases. So you kind of have to understand what it is.
Your software systems, your EMR, all of that stuff. Next topic is the financial side of things. And needless to say, this is probably one of the most important topics that you'll have. And you'll probably spend the most of the time thinking about this when entering into these affiliations. As I said before, but I think it's worth mentioning again, when you go into these deals, make sure you plug into the comp model or the expected comp model the history in terms of the practice, what codes you use, how often you use them, what procedures you're doing, and the like. You want to make sure that what you expect in terms of the overall compensation at least makes sense in terms of what you've done historically.
Keep in mind that what we do a lot is we make sure that they have some type of coding expert come in beforehand, because sometimes the practice's coding may not be at the same level as the hospitals, and the hospital may either lower the code or higher it based on your documentation. So you need to know in advance as to whether what you think you have from an RVU perspective really is what the hospital will deem it. Otherwise, you'll be set for some really big surprises, and usually they're negative.
Right. So more specifically, what are the payment models? Well, typically we see either flat salaries, which is more in the employment structure, or somehow production-based, which is often in terms of both of the models. And more specifically on the production-based, we typically see things less in terms of collections and more in terms of RVU.
Right. If you're going to do, if they ask you to do collections, argue it because you can't control whether they collect or they don't collect. And hospitals are notoriously bad at collecting. So try to make it based on what's been billed and based on your RVU rather than collections.
And again, as I said before, the lingo that the practice is used typically is not in the context of RVUs. So you need to almost retrain yourself and make sure that whatever production you're doing, when you convert it to RVUs, again, is in line with what you expect. But regardless of the the model, the economic model, the key phrases that will come up over and over and over again are fair market value and commercially reasonable. Whatever the hospital is going to pay, and whether it's under the employment model or the professional services model, and whether it's a salary or a production-based structure, whatever it is, it's going to need to come back to and reflect fair market value. And again, in terms of what a doctor perceives that he or she is worth in terms of their services, may not necessarily align with fair market value. The hospitals will almost always do a fair market value analysis out of the gate, and that way they can peg back the economics to fair market value. So now let's talk more specifically about RVUs, because oftentimes, or I'll say most of the times, that is a part of the compensation model. So what do we typically see? When we see the RVUs built in, we typically see a base amount of RVUs. In other words, for every RVU generated, the practice will receive, or the physician will receive, blank dollars per RVU. On top of that, oftentimes the benefits are translated, or benefit payments are translated into RVU, so that for every RVU generated, again, there's some dollar figure that will be contributed for benefit purposes. And then lastly, a lot of systems introduce what's called quality metrics or quality incentive amounts, essentially a bonus of some sorts of a per dollar per RVU bonus based upon quality benchmarks, patient satisfaction, use of EMR, how timely it's done, how timely the charts are completed, how complete they are, and other benchmarks like that. With that in mind, oftentimes you need to work with the hospital in creating those benchmarks. It may not exist, or it may not exist for your specialty, and so you'll need to have your hand in that, because if this is part of the economic model, you want to make sure that these are achievable goals and not out of reach to be worthless in the context of the deal. What RVUs do you get credit for? Typically, you get credit for the physician owners, the partners. Typically, you get credit for the associates, and typically you get incident two, your PAs, your nurse practitioners, etc. RVUs oftentimes will adjust over time, or the hospital will ask that adjust over time to reflect fair market value. So if this is the case, the group will want to either lock it in for a longer initial period, or have some type of collars or limitations in terms of how it could be adjusted, or ultimately, if it can be adjusted, and obviously if it's going to be adjusted, the hospital's going to want to adjust it downward. If it's going to be adjusted, that if it's not something that the physicians are comfortable with, that they have the ability to terminate the relationship and walk away, and importantly, not have a restrictive covenant. On a going forward basis, the RVUs are calculated based upon published rates. There's typically little argument in terms of what each RVU is tied to, what procedures. However, the question becomes is, what is the rate schedule that you're talking about? Is it at a fixed period in time or date in time, or is it something that is going to change as new schedules or published rates are put out? In terms of a cash flow perspective, when is the money actually paid to the doctor or to the practice? Some systems will only pay in arrears. In other words, you do the procedure, you perform the service, and then you get paid after the fact, at the end of the month or after the end of the month. That it creates a gap between the time you actually do the procedure and the time you get paid for it. And so if that is the model that you're using, you want to reduce that amount of time as much as possible. On the flip side, many systems will do an estimate up front with periodic reconciliations, whether monthly, quarterly, or more often. And obviously from a practice perspective, that would be the desired path to go. That being said, the estimate is not typically paid on 100% of the expected production. Typically, the hospitals hold a little back so that there's a shortfall rather than an overpayment. That way the hospital has some money in its pocket at the end of the day. That will then be adjusted later on. Some systems will do sort of a combination and make sure that things are done properly and during a review process, and then at some point when the hospital is comfortable with the way things are billed and charted and coded, that they then take you off the review process and perhaps do it a different way of timing. So all of that needs to be clearly defined, what it means to be in the review process and when you become off or get off the review process. Other specific things to think about economically in terms of the PSA, the professional service model and the employment model. In the PSA model, keeping in mind and reminding yourself back in terms of the structure, the doctors will stay on the payroll of the practice, of the professional corporation. And so the group is responsible internally for determining their compensation, their benefits, their sick, their time off. The hospital is going to write one overall check for the group for the overall aggregate RVUs generated by everybody. The group then allocates it among the physicians how they want. In that case, then everybody remains on the group's payroll. They're responsible for all the withholdings, and so all of these economics need to be factored in. If you're on a direct employment, everybody's moved over to the hospital's payroll, so they're responsible for all of that. Talked a little bit about this already, but you've got a pot or a pool of RVUs generated by the group. You need to consider and think about how it's split up among the group, and that needs to be internally worked out in advance. And then lastly, you'll want to receive reporting from the hospital, how many RVUs are generated, when, by whom, and things like that. From a budgetary perspective, when you're on an employment model, essentially everything is moved over to the hospital, and therefore all the expenses are direct expenses of the hospital. When you're in a PSA model, oftentimes there's a budget component. The hospital will pay on an overall budget to the group, and the group then is responsible for writing the checks. And so it is very important in this model for all the checks that need to be written, that they are spelled out clearly in terms of what all those line item expenses are. So personnel salaries, the fringe benefits, all the other expenditures in terms of equipment costs, supplies, rent, utilities. It's critical that all of that is factored into the budget. And so therefore you need to make sure that you've got your proper financial folks input on that. The structure is typically you'll have an annual budget, you'll live within the budget, and then every year the new budget is set and the payments are made per the budget. If it's not in a budget, then you may not get paid for it. So it's important that all of the line items are in the budget. And since annual budgets need to be redone every year, you'll need to have some type of default mechanism in place if a subsequent budget is not agreed to. What happens? Do you use the prior year's budget? And if so, there are various line items that you could adjust off of it. Similar to the other RVU payments, when is it paid? When is it reconciled? If there's other financial items, management fees, things like medical director stipends, things like that, it's got to be factored into. How long is the relationship? Typically, the relationships are anywhere from one to 3 years at the low end to 5 years at the upper end. What happens is it evergreen at the end, meaning automatic renewals? And then what are the termination provisions? And these are the type of termination provisions that you'll see in your customary employment agreements that you have with your associates, things like that. So loss of licenses, bankruptcy issues, defaults, things like that.
Keep in mind that you want to make sure that if you're a large group that's affiliating, if one of the doctors this happens to, you want to have the ability to terminate that physician and still keep the arrangement going if that's one of the options.
And importantly, is there the ability by the hospital to terminate without cause? You may have a 5-year term, that would be great, but if the hospital has the ability to terminate without cause at any time, you really don't have a 5-year term. You have a term of a relationship that could be unwound at any time. And speaking of unwinding, so what happens at the end of the relationship? At some point, the relationship's going to expire and end. And so what happens? You want to make sure you have all the mechanics in place to take back your practice. Get back the hard assets if you've in fact sold your assets over, your equipment, etc.
Too many times people wait until it's too late and the leverage is gone and you don't have all those terms on how you unwind zipped up. So it's very important to lay it out up front because the hospital up front wants you and you have the ability to negotiate better terms.
Exactly. So what are the things to think about? Again, getting back your assets, reassignment of the office lease and any equipment leases that you might have signed over. Very important is the EMR systems and the medical records. How do you get back your medical charts? If you're electronic, how do you get back the electronic charts? If it's paper, it's easier. But from an electronic perspective, if you've got 2 different systems or if you're not going to use the hospital system on the unwind, how do you repopulate all the data into your system? You want to make sure that on the day that you unwind, you've got the ability to continue business as usual. And so with that, one thing to keep in mind also is that when you go back to your private practice, your private structure, you will not have billed through your taxpayer ID number during the course of the relationship. And so your payer contracts go stale. And there's that lag period between trying to get back into your payer contracts and actually being able to bill. Needless to say, that could have really bad economic cash flow issues. So what we often suggest is allowing each practice during the course of the relationship just to bill enough through each taxpayer ID number, through each payer plan, so that each payer plan still remains good. That way, the day you unwind, you can still bill immediately. You'll have a restrictive covenant in all likelihood that will somehow restrict the group from doing certain activities post-affiliation. Typically, it's 1 to 2 years. Typically, it does not restrict going back to private practice. So it'll allow you to go back to the practice that you were in. Typically, it allows you to keep privileges wherever you've had privileges. There are scenarios that you may want to think about in terms of termination that perhaps the restriction not apply to. If the hospital is the one initiating the termination, if it's not renewed, and other triggers, perhaps the restrictive covenant should not apply in that scenario. But long story short, the restrictive covenant typically prohibits affiliating with other hospital systems and even sometimes prohibits aligning with other groups, larger groups.
Right. So you have to think out, if this doesn't work, what are you going to do, and try to carve that out. Sometimes it takes an intermediate step when you unwind. You may go back to your own practice for a year and then you can go and do something else. But it's very important to understand what that is and where you're going so that you can plan appropriately, because again, the leverage is on the physician practice when they're joining, because the hospital wants you, because the hospital ends up capturing not only your referrals, but also a lot of your ancillary revenue, which you won't be able to continue to maintain down the line.
Typically, you'll see a mutual restriction on soliciting each other's employees. You just want to make sure that it's very clear that you always can take back the employees that were at your offices. And lastly, in terms of the restrictive covenant, who should it apply to? It typically applies to the partners, but should it apply to the associates as well? Keeping in mind that oftentimes you've got specific employment agreements with specific restrictive covenants with the associates. So do you want to drag them in and have them sign something with the hospital? Oftentimes it becomes cumbersome to have that happen. We've talked a lot already about information technology, the EMR systems. So on the pre-affiliation tasks, whose EMR system is going to be used, talking about or thinking about integration costs, who's paying, if new equipment is needed, who's paying, and the like. From an operational perspective, again, keeping in mind that now you're within the hospital system. You don't have the flexibility as you often did in the past, that you can do all the things that you want to do when you can do it. So first is from a physician and staffing perspective, can you add new professionals, new staff with or without hospital approval? Do you need the hospital's consent or not? If you know that you're going to have a greater patient demand, oftentimes you build into the relationship up front that you have the ability to hire somebody new, that the hospital is going to help recruit, that the hospital may provide some type of income guarantee for that, for that new physician. But taking it full circle is without the proper mechanisms in place, you're going to need the hospital's approval to hire new people, whether it's physician or non-physician. And so you just want to make sure you think through that process. From a location perspective, where are you going to work? Where do you need to do your services? You don't want to, from a physician perspective, be required to work anywhere where the hospital wants you to work, anywhere where it's determined necessary. You want to limit or specifically identify the offices and hospitals where you're going to be at. And importantly, whose practices are you going to cover? Are you going to cover just your practice? If you are somehow rolled in with other practices, do you have to cover their patient population, whether it's the day-to-day or from a call perspective? So again, identifying clearly the who are you going to be performing for and where you're going to be doing it. Full or part-time considerations, outside activities. If there are outside activities that you do, whether it's medical or non-medical, moonlighting, medical directorships, or the non-medical teaching, lecturing, things like that. If you do any of that and expect to keep the money, you need to specify that up front. Otherwise, you're going to need the hospital's consent every single time. Mentioned this a little bit already, but in terms of staff, the hospital is going to want involvement in terms of who works at the offices and in this affiliation. And so you need to make sure that you are comfortable with the logistics in terms of how much involvement that the hospital is going to have in terms of hiring, firing, placement, time, things like that. Same with the equipment and other purchases. I mentioned at the outset that you lose a great deal of control in terms of the finances. Whereas in the old structure, you had the ability to say, I need to buy something and then go buy it. Now you need to do it within the confines of the affiliation. If you're a direct employment model, the hospital has probably internal procurement policies, and you certainly will need the hospital approvals. So you need to go through that process. If you're in the PSA model and there's a budget, you need to make sure that whatever you're contemplating is contemplated within the budget. If not, then you need to talk to the hospital about it. Otherwise, if you actually do incur that expense, that it may come out of your pocket. From a malpractice perspective, typically the hospital pays for it. You just need to make sure that if you're comfortable with your current policies, that you can continue to stay on your current policies rather than being forced to terminate and go on the hospital's policy.
And now, we've gone through this stuff. We only have a couple minutes, but there are a bunch of other options that you can have to hospital affiliation. Among them is setting up a super group, which is a large group practice. It could either be single specialty or multi-specialty. You can join an existing one. You can start a new one. You can join a clinically integrated network, which means that you'll have your own practice and you maintain your own practice, but as long as you're clinically integrated, you can jointly negotiate payer agreements. Another option is dealing with private equity or selling part of your practice or the management aspect, the non-clinical aspects to private equity, and that's a whole nother topic. So we're going to open it up for questions because we only have about 2 minutes left, but we would be willing to do another presentation on either supergroups, clinically integrated networks, or private equity in the future for you as another option. Okay, with that, we're going to open it up.
Okay, folks, if you have any questions, please get them in the question box. I know that Peter and Michael covered things very thoroughly because I don't see any questions right now, but we'll give it a couple seconds and see if any pop up, and if not, we'll close the webinar out and get the presentation out to everyone.
See, we've either done a very good job or we put everyone to sleep.
I think it's that you've done a great job. I don't see anyone typing, so fantastic. Thank you, everyone, again for attending. The webinar will be archived and up later this afternoon, and you'll have an email today with the presentation. Again, if you do have any questions, you can follow up directly with Michael or Peter. Their contact information is on the presentation. And thank you all for attending. Have a great day.
Thank you.
Thank you, everyone.